Imagine borrowing $500,000 at a staggering 13% interest rate.
Okay.
And then, genuinely considering the smartest financial decision you have made all
I
year.
mean, it sounds completely counterintuitive, right?
Totally.
Yeah.
Because we are taught from day one that high interest rates are just, well, financial poison.
Absolutely.
But today, we are looking at this hidden corner of the real estate market where the smart money is happily paying credit card level interest rates, plus these hefty upfront fees just to avoid walking through the front doors of a traditional bank.
Yeah, it completely flips everything we think we know about borrowing money.
It really does. So welcome to today's deep dive. I am thrilled you were joining us.
And what we're going to explore today is why that high interest rate is actually a calculated tool for wealth creation rather than, a debt trap.
Right.
Because the financial landscape we are looking at operates entirely on a different set of physics than the consumer banking world most people interact with on a daily basis.
Yeah, and our mission today for you listening is to decode those hidden mechanics. We have this incredible stack of source material to guide us. It's a collection of articles, market analyses, and blog posts published by a specialized San Diego hard money lender.
Written between late 2025 and early 2026.
Exactly. So these are dispatches directly from the front lines of one of the most brutal, fast-paced, and expensive real estate markets in the United States.
And these sources are so compelling because they don't just talk theory.
No, not at all.
They peel back the curtain on how professional investors, developers, and entrepreneurs actually move capital. I mean, when you were taught how to buy a house, the recipe is pretty standard, right?
Oh yeah, you get a stable W-2 job, you save a down payment,
You go to a nice air-conditioned bank branch, hand over a mountain of paperwork.
can wait 30 to 60 days for a committee to stamp your file.
Exactly. But the sources reveal that in hyper-competitive environments, that recipe is actually a recipe for failure.
And I really want to set the tone right out of the gate here for you, the listener. Because even if you have absolutely no plans to ever buy a piece of property in Southern California, or anywhere else for that matter, you need to stick around.
Oh, without a doubt.
Because understanding these specific financial mechanics reveals so much about how wealth is actually built and how assets change hands behind the scenes in America.
It is really about understanding the levers of a financial system that operates parallel to the one most of us use.
Right. But to really grasp the solution, which is this alternative financing, we have to start by completely understanding the problem it was built to solve.
You cannot understand the evolution of a tool without understanding the environment that demanded it.
Makes sense.
And the problem, as outlined extensively in our sources, is the sheer velocity of the modern real estate market, specifically highlighted through the geographic and economic lens of San Diego, or, as the sources frequently refer to it, the 619 area code.
The 619, the San Diego battlefield. So let's look at the realities on the ground. The sources describe a market suffering from historically low inventory.
Severe low inventory.
Yeah, we are talking about prime properties in highly desirable neighborhoods, North Park, Pacific Beach, Chula Vista, Encinitas. But let's dig into the why here. Why is inventory so low in a place like San Diego? It's not just a temporary blip, is it?
No, it is a structural, geographic, and regulatory reality. Just think about the geography of San Diego for a second.
No.
You have the Pacific Ocean forming an absolute barrier to the west.
Obviously.
You have the international border with Mexico shutting off expansion to the south.
Right.
To the north, you have Camp Pendleton, which is this massive Marine Corps base that completely blocks urban sprawl.
Oh, wow. I didn't even think about the military base.
Yeah, it's a huge footprint. And then to the east, you quickly run into mountains and desert. So the physical footprint for housing is severely constrained.
It's literally boxed in.
Exactly. And when you combine that strict geographic boundary with notoriously complex local zoning laws and coastal commission regulations, plus local neighborhood resistance to dense development, you get a systemic, chronic shortage of housing.
So supply is physically capped.
Yeah.
But demand, because of the climate, the economy, the lifestyle, the demand is always surging.
Always.
And that creates a pressure cooker. The sources paint a picture of a market where when a decent property finally hits the MLS,
The listing service.
right, the master database all the real estate agents use, when a property hits that, A bidding war doesn't start in a few weeks. It starts within hours.
Hours. Which brings us to the core friction point. The traditional banking model completely fractures in a pressure cooker like that.
How so?
Well, if you are an investor looking to buy a distressed property or even just a highly qualified traditional home buyer, and you walk into a situation in North Park where there are 12 other offers on the table.
Which is pretty standard there.
It's very standard. You are at a massive disadvantage if you are using conventional financing. You are carrying a pre-approval letter from a major bank that requires a 30 to 60-day closing window.
Right.
In a market moving at light speed, a 60-day timeline means you have already lost before you even submitted the paperwork.
It's like trying to use a traditional 60-day bank loan in a market like North Park is like showing up to a drag race in a minivan.
That's a great way to put it.
Like you might finish the race eventually, but the other guy has already taken the trophy and gone home.
You're just breathing their exhaust.
Exactly. But I really want to pause and look at this conventional bottleneck, because on the surface, 30 to 60 days doesn't seem that crazy in the grand scheme of buying a massive physical asset like a building.
Sure, it sounds reasonable to normal people.
Right. So is a 60-day close genuinely a deal killer? Or is there a bit of, marketing hype from private lenders in these sources? Like, why can't a seller just wait a month and a half to get their money?
To understand why it's a deal killer, we really have to look at the psychology and the risk exposure of the seller.
Okay, put me in the seller's shoes.
Imagine you are selling a property in Encinitas. It needs some work, but it's in a great location. You receive two offers.
Okay.
Offer A is from a traditional buyer using a conventional mortgage. They are offering your full asking price.
Sounds good so far.
But that conventional mortgage comes with a massive string attached. The bank's underwriting process.
Which takes 2 months.
It takes up to 2 months, yes. And during those 60 days, the seller is basically held hostage to the bank's internal bureaucracy.
Wow, hostage is a strong word.
But it's true. The bank is going to order an appraisal. If the appraiser decides the house is worth $10,000 less than the offer price, the bank won't fund the difference.
And the deal might die.
Right. Then the bank's underwriting committee is going to forensically audit the buyer's life.
Good boy.
If they find a weird deduction on the buyer's tax return from 2 years ago, the deal might die. If the buyer buys a car during escrow...
Oh, I've heard about that. It ruins their debt-to-income ratio.
Exactly. And the deal dies. If the bank decides they don't like the condition of the roof, the deal dies.
So it's just a minefield.
The seller is taking their home off the market for 60 days of intense, nail-biting uncertainty.
Ah, so the bank is essentially looking for reasons to say no. But why are conventional banks so rigid? Like, why do they care about a 2-year-old tax deduction if the person has a good job now?
Because of the secondary mortgage market and federal regulation.
Okay, unpack that for me.
A major bank, say a Wells Fargo or a Chase, they rarely keep your 30-year mortgage on their own books.
Wait, really?
Well, rarely. They don't want their capital tied up for 3 decades. Their business model is to originate the loan, collect the fees, and then immediately bundle your mortgage with thousands of others.
And sell it off.
Yes, sell it to government-sponsored entities like Fannie Mae or Freddie Mac.
Okay, I've heard of them.
But Fannie Mae will only buy that bundle of loans if every single mortgage meets an incredibly strict, federally mandated checklist.
Ah, so there's the bottleneck.
Right. If a local loan officer approves a borrower who is missing, say, 1 page of a tax return, Fannie Mae rejects the loan and the bank is stuck holding it.
They get penalized.
Exactly. So the bank's underwriting process isn't really about assessing true risk. It's about perfectly matching Fannie Mae's bureaucratic checklist.
Okay, so the conventional buyer is dragging this massive bureaucratic compliance machine into the negotiation with the seller.
Precisely.
Now, what does Offer B look like?
Offer B is an investor utilizing alternative financing, the hard money we see discussed in our sources.
Okay.
They might offer a little bit less money than Offer A. Maybe they offer 5% under the asking price.
Less money, but...
But they guarantee they can close the transaction in 7 days.
7 days. Wow.
There is no traditional bank committee. There is no rigorous 60-day audit of their personal tax history. The capital is essentially guaranteed to hit the seller's bank account by next Friday.
So if you are the seller, which Offer gives you peace of mind. I mean, if I am the seller, I am taking Offer B without a second thought. I would gladly trade a small percentage of the purchase price to completely eliminate 60 days of anxiety and the risk of the deal just falling apart.
And that seller psychology is the fundamental driver of the alternative finance industry. It completely shifts our understanding of how capital is valued.
How so?
Well, in everyday personal finance, we are conditioned to focus entirely on the cost of capital.
Right, interest rates.
We are taught to hunt for the absolute lowest interest rate possible, down to the fraction of a percent.
Yeah, I'll shop around for weeks to save 0.5% on a car loan.
Exactly. But the professional investors in these sources operate on an entirely different metric, the availability of capital.
The availability of capital, meaning if the money isn't there exactly when the window of opportunity opens, it doesn't matter how cheap it is.
Precisely. The traditional bank is a lead weight in this environment. It operates on predictability and standardization. It does not operate on opportunity.
Right.
If a 6% bank loan takes 60 days to close and you lose the property to a faster buyer on day 4,
Which happens all the time.
the fact that the loan was cheap is completely irrelevant. 0% of a lost deal is still 0.
That is a massive mental shift. Cost of capital versus the velocity and availability of capital. It makes me want to turn to you, the listener, for a second. Have you ever missed out on something important? Maybe a job opportunity, an apartment rental, or a chance to buy something rare, simply because the standard process or the traditional way of doing things was just too slow.
It's a frustrating feeling.
Oh, it's the worst. Have you ever watched someone else swoop in and take the prize because they bypassed the bureaucracy? That exact friction is what birthed the entire multi-billion-dollar hard money industry. The conventional bottleneck became so severe that a parallel financial system just had to evolve.
And to understand how this parallel system achieves that velocity, we have to look at its structural foundation.
Let's do it.
Because if traditional banking is too slow, how do these alternative lenders speed up the process to close in 7 days? I mean, they aren't just magically working faster.
Right, they can't just type faster on the keyboards.
They are fundamentally changing what they are evaluating.
Okay, so let's define the terminology first, because the sources use the phrase hard money constantly. And honestly, to someone outside the industry, that sounds like a loan from a mobster in an alleyway.
It does sound a bit shady, doesn't it?
It really does. What exactly is a hard money loan?
The term definitely has an intimidating ring to it, but it simply refers to a short-term asset-based loan secured by real estate.
Asset-based.
Right. The word hard does not mean the loan is difficult to obtain, nor does it refer to the interest rate. It refers specifically to the physical hard asset itself.
The property.
The property, the dirt, the foundation, the roof.
So the physical real estate is the absolute center of the universe for these lenders. How does that differ from the bank?
Well, think back to the 60-day conventional bank process. We established that traditional banks underwrite the borrower.
They put the human being under a microscope.
Exactly. They are evaluating your credit score, your debt-to-income ratio, your W-2 employment history, every single deposit in your checking account.
They're making a 30-year bet on my ongoing ability to remain employed and responsible.
Right. They are evaluating your life choices.
Which is terrifying.
Hard money lenders, however, underwrite the deal. Their primary focus is the property itself.
So they don't care about me as much.
They ask an entirely different set of questions. What is the current as-is value of this property? If the investor is going to renovate it, what is the after-repair value?
The ARV.
The ARV. What is its income-producing potential? And most importantly, how is the borrower going to pay this short-term loan back?
I want to use an analogy here to make sure we are crystallizing this difference for everyone listening, because it feels very similar to how a highly sophisticated pawn shop operates.
Okay, I like where this is going.
Like, if I walk into a pawn shop to get a loan, and I hand over a solid gold Rolex watch as collateral, the pawnbroker doesn't sit me down and ask to see my resume.
No, they certainly don't.
They don't pull my credit score, and they definitely don't ask for 2 years of tax returns. They just take out a loop and they look at the watch.
They weigh the gold.
They authenticate the movement. Their entire risk calculus is basically, if this person never walks back through that door, can I sell this Rolex to someone else and make my money back?
Exactly.
They care almost exclusively about the asset I am handing them, not my personal financial history. Is that a fair way to think about a hard money lender?
It is a brilliant way to conceptualize it, assuming we acknowledge that commercial real estate is vastly more complex than a watch.
Fair enough, yeah.
But the core philosophy of risk assessment is identical. It is a total paradigm shift. Let's look at a practical example.
Okay.
Suppose you have a borrower with a 620 credit score.
Which is pretty low.
It is. A conventional bank algorithm looks at that number and immediately flags the borrower as subprime, high risk.
Auto decline.
The bank denies the loan, end of story. They don't even look at the house the person's trying to buy.
Even if it's the deal of the century.
Exactly. Now, that same borrower takes the same deal to a hard money lender. The hard money lender notes the low credit score, but then they look deeply at the asset.
The Rolex.
The Rolex. They realize the borrower has a contract to buy a distressed property for $300,000 in a neighborhood where renovated homes are selling for $600,000.
That's a huge margin.
The lender looks at that spread and says, well, there is massive equity here. Even if this borrower defaults on our loan tomorrow, we can foreclose, take the property, sell it for $400,000 as is, and easily recoup our entire investment plus profit.
Wow. So the asset protects them.
The asset protects us. Therefore, the loan is approved despite the borrower's personal credit history.
And because they are entirely focused on valuing the property rather than forensically auditing the borrower's life, they just completely bypass weeks of administrative delays.
That is the secret to their speed. The sources state that a standard closing time for a hard money loan in the San Diego market is 7 to 14 days.
Unbelievable.
And if the title work is clean and the appraisal can be rushed, they can sometimes fund a deal in as few as 5 to 7 days.
That is how a buyer using a loan can compete directly with a buyer paying pure cash. They bring capital that moves at the speed of the market.
Exactly.
But this raises a major question for me. Like, if this asset-based model is so incredibly efficient, why don't the major banks just adopt it? Why doesn't Bank of America just say, you know what, we're going to look at the asset too, skip the Fannie Mae checklist, and close in 7 days?
It comes down to the source of the capital.
Okay.
Traditional banks are using consumer deposits, your checking and savings accounts.
Oh, right. My money.
To fund their operations, which means they are subject to massive federal oversight to prevent them from gambling away the public's money.
That makes sense. We don't want them gambling our savings on rifty flips.
Exactly. Furthermore, as we discussed, they need the liquidity of the secondary market to keep lending.
To sell to Fannie Mae.
Right. Hard money lenders, on the other hand, are typically private entities. We are talking about specialty finance companies, family offices, wealthy individuals, and private equity funds.
So they're lending their own private money.
Yes, and because it is private capital, they answer to themselves, not to a federal banking regulator or Fannie Mae.
Right.
They have the autonomy to apply human logic and common sense underwriting to a deal. If a situation is unconventional but mathematically sound, they can simply say yes and wire the funds.
They aren't trapped by a rigid one-size-fits-all algorithm.
They are completely free from it.
That autonomy is incredibly powerful. And as I read through the sources, it became clear that once you shift the focus from the borrower to the asset, it unlocks an entire specialized toolkit of financial products.
It really does.
It is no longer just a vanilla 30-year fixed mortgage. Alternative lenders have engineered specific tools to solve specific real estate problems.
Because when you remove the 30-year timeline, you can structure the capital to match the exact life cycle of the investment strategy.
So let's walk through that toolkit, because the sources detail several of these specialized tools, and together they kind of map out exactly how neighborhoods in a city like San Diego are physically transformed.
Let's do it.
The first one the sources highlight is the classic fix and flip loan.
Very popular.
Yeah, they mention these are heavily utilized in older San Diego neighborhoods, places with aging housing stock like City Heights, Logan Heights, and Sherman Heights. These are short-term loans, usually 6 to 18 months. But the mechanic that fascinated me here is the draw schedule. It's not like the lender just hands the investor a duffel bag full of cash at closing to go remodel the kitchen, right?
Far from it. The draw schedule is a vital risk management mechanism. Let's walk through the exact mechanics.
Okay, let's hear it.
Let's say you buy a dilapidated house in Logan Heights for $400,000.
Okay, $400,000 for the house.
You present a detailed budget showing it will cost $100,000 to fully renovate it. New roof, new plumbing, new kitchen.
All the works.
So you are asking the hard money lender for a total loan of $500,000.
Got it. $400,000 for the house, $100,000 for the work.
At closing, the lender only funds the $400,000 to actually purchase the real estate.
Right.
The remaining $100,000 for the renovation is placed into an escrow holdback account. You do not have access to it on day one.
Wait, so I own the house, but I have no money to pay my general contractor to start the demolition. How does the work actually happen?
This is where the investor's own liquidity comes into play. You, the investor, use your own initial working capital to pay the contractor to complete the first phase of the project.
Ah, I have to front the cash.
You have to front it. Let's say the demolition and the new framing. Once the framing is physically completed, you submit a draw request to the lender.
Basically saying, hey, I did the work. Please reimburse me from that escrow account.
Exactly. But the lender doesn't just take your word for it.
Of course not.
They hire a third-party inspector who drives out to the property in Logan Heights, walks inside, and physically verifies that the old walls are gone and the new framing is up and matches the permitted plans.
Oh, wow, they actually send someone out.
They absolutely do. Only after the inspector signs off does the lender release that specific portion of the renovation funds to your bank account.
Okay.
Then you use those funds to pay the plumbers and electricians for the next phase, and the cycle repeats.
That is fascinating. So the lender is essentially forcing you to prove that you are adding value to the property before they increase their financial exposure.
And if we look at the underlying philosophy, these draw schedules aren't just loan terms, they are strict project management enforcement tools.
Right.
Remember, the lender's only real protection is the value of the physical asset. If they handed you the entire $100,000 up front,
I could just run off to Las Vegas.
you could run off to Las Vegas, or you could hire an incompetent contractor who accidentally burns the house down.
Which would be bad.
Very bad. In that scenario, the lender is left holding a loan for $500,000, but the property is only worth $400,000. By tying the release of funds directly to verifiable construction milestones, the lender ensures that the property's value is rising in lockstep with the loan balance.
It is a built-in accountability system. I love that. Okay, so the draw schedule protects the lender on a heavy renovation. But what happens if a property doesn't need to be gutted?
Good question. Like, what if the problem isn't the condition of the house, but the investor's timing? That brings us to the next tool in the sources, which are bridge loans. They call them the connective tissue of real estate transactions. Bridge loans are designed to solve the inevitable timing mismatches in a complex market. Real estate transactions rarely line up perfectly on a calendar.
Never.
Let's imagine the domino effect of a transaction.
Okay.
You own a commercial building that is currently under contract to sell. You plan to use the massive profits from that sale to purchase a much larger, better apartment complex. You have a closing date set for the new purchase.
Everything is lined up perfectly.
Until it isn't. Suddenly, the buyer of your first building hits a snag. Their financing is delayed by 3 weeks. The dominoes stop falling.
Oh, no.
Now, you are going to miss the strict closing deadline on your new apartment complex. In a competitive market, the seller of that complex won't wait.
They'll just move on.
They will cancel your contract, keep your deposit, and sell it to the backup offer. You are about to lose the deal of a lifetime simply because your timeline shifted by 21 days.
That is where the bridge loan steps in to stop the bleeding.
Precisely. The hard money lender steps in and provides a bridge over that gap. They give you a very short-term loan, perhaps only for 3 to 6 months, that allows you to close on the new apartment complex today using the equity trapped in your existing building as collateral.
Wow.
You secure the new asset. 3 weeks later, when your first building finally sells, you take those proceeds and immediately pay off the bridge loan.
It's essentially buying time. It's a financial shock absorber for when the logistics of the real world don't match the paperwork.
Exactly.
What else is in this alternative toolkit? The sources dedicate quite a bit of space to ground-up construction loans.
Ground-up construction is exactly what it sounds like. Financing the building of a structure from a completely empty dirt lot.
Right.
The mechanics operate very similarly to a fix-and-flip loan, utilizing strict draw schedules for the foundation, framing, roofing, and so on. But the context the sources provide regarding San Diego makes this crucial.
Because of the housing shortage we talked about earlier.
Exactly. San Diego desperately needs new housing units. The sources point out that this demand is driving 2 distinct types of development.
Which are?
Urban infill, which means squeezing new, dense housing into small, empty lots in the city center.
Like putting a duplex in a backyard.
Right, and larger suburban developments in expanding areas like Otay Ranch.
But why are hard money lenders funding this? Why aren't the big conventional banks financing the construction of new homes if the demand is so high?
Traditional banks are notoriously terrified of dirt.
Terrified of dirt.
Yes, financing ground-up construction is inherently incredibly risky. The potential for catastrophic delays, permit nightmares, supply chain breakdowns, and massive cost overruns is immense.
Yeah, I've watched those home renovation shows. It's always a disaster.
Right, and a bank algorithm simply cannot price in the risk of hitting solid bedrock when excavating a foundation.
Good point.
Hard money lenders, however, specialize in this. They have the local expertise to evaluate architectural plans, permit timelines, and contractor track records. They are willing to take on the execution risk because they know how to underwrite the future value of the completed project.
So they are the actual capital engine physically creating new housing supply, where traditional banks just refuse to tread.
They absolutely are.
Which naturally leads us to the biggest asset class discussed in the sources. They refer to it as the current gold rush for smart money in San Diego, multifamily loans.
Yes, multifamily.
We are talking about duplexes, fourplexes, and large apartment buildings. Why are the professional investors in these sources so obsessed with multifamily properties right now?
It comes down to two foundational principles of commercial real estate: economies of scale and risk mitigation.
Okay, let's break those down.
Let's compare it to single-family investing. If you own a single rental house and your one tenant moves out, your vacancy rate instantly jumps to 100%.
Boom, zero income.
The income drops to zero. You are now paying the entire mortgage, the taxes, and the insurance out of your own pocket until you find a new renter.
That is a very fragile income stream.
It is highly exposed to single-point failure. Now, look at a 10-unit apartment building.
Okay.
If one tenant moves out, your vacancy rate is only 10%.
Right.
You still have 9 other tenants paying rent every single month, which is usually more than enough to cover the debt service and operating expenses while you turn over the empty unit.
So the risk is distributed.
Exactly. Smart money flocks to multifamily because the cash flow is significantly more stable.
Oh.
But the real gold rush is in how multifamily properties are valued.
This is where it gets super interesting.
It requires a quick explanation of commercial valuation. A single-family home is valued based on comps, what the house next door sold for.
Right.
Commercial multifamily properties are valued based primarily on the income they generate. It's a mathematical formula utilizing net operating income.
So if you can increase the income, you automatically force the value of the building up, regardless of what the houses next door are doing.
Precisely. This is called value-add investing. An investor uses a hard money bridge loan to buy a tired, outdated 20-unit apartment building where the rents are significantly below current market rates.
Okay, so they buy it cheap.
They use the renovation funds to update the units, improve the exterior, add amenities. Because the units are now much nicer, they raise the rents to match the current market demand.
Which makes sense.
By dramatically increasing the rent roll, they exponentially increase the mathematical value of the entire building.
Wow.
Once the building is fully renovated and fully leased at the new higher rates...
Which the sources call stabilizing the property, right?
Yes, stabilizing. Once it's stabilized, they go to a conventional commercial bank and refinance the short-term hard money loan into a long-term, lower-interest mortgage.
It really is a highly sophisticated, interconnected ecosystem of specialized tools.
It's brilliant.
But as I was pouring through these sources, the section that truly blew my mind wasn't about how they evaluate the bricks and mortar.
No.
No, it was about how these alternative lenders have adapted to evaluate the people buying the real estate.
Yes.
We talked about how traditional banks rely heavily on W-2s and standard salaries. But the sources dive into a total revolution in underwriting designed for the changing nature of modern work.
It's a massive shift.
Let's explore DSCR and bank statement loans.
This is perhaps the most fascinating part of the alternative lending world because this is where specialized finance intercepts macroeconomics.
All right.
To understand these loans, we have to look honestly at how people actually make a living today versus how they made a living in the 1980s when traditional bank underwriting rules were written.
Right. The traditional bank model, give us your W-2s, show us your consistent salary from your one employer for the last 2 years. It just feels incredibly outdated.
Very outdated.
An enormous segment of the economy today operates outside of that model. So many people are gig workers or freelance creatives or tech consultants, or they run their own small businesses, or they have a day job plus 3 different profitable side hustles.
Exactly.
Their income is very real, and it is substantial, but their tax returns look like an absolute labyrinth of deductions and write-offs.
And that is exactly where the conventional banking system completely fails the modern entrepreneur. Let's look at a realistic scenario.
Okay, lay it on me.
Imagine you are a highly successful freelance software developer living in San Diego. Through your LLC, you generate $250,000 a year in gross revenue.
Nice. You are making excellent money.
You also have a fantastic certified public accountant.
And their job is to make sure you pay as little in taxes as legally possible.
Exactly. Your CPA is going to legally write down every possible expense. They deduct the portion of your rent used for your home office. They deduct your internet, your servers, your travel, your business meals.
The depreciation on your computer equipment.
Maybe even a company vehicle. By the time they are done, your official IRS filed tax return might show a net taxable income of only $45,000.
So you saved a fortune in taxes.
Mm-hmm.
But what happens when you take that $45,000 tax return into a branch of Chase Bank and try to get a mortgage for $1 million house in San Diego?
The bank's algorithm looks at you, categorizes you as poverty level risk, and laughs you out of the building.
Wow.
The bank is legally required to underwrite based on the net income shown on the tax return. They completely ignore the $250,000 of actual cash flowing through your accounts.
So the system penalizes entrepreneurs for utilizing the very tax code the government wrote.
Yes.
So how on earth does a self-employed person prove to a lender that they can actually afford a building?
Mm-hmm.
How does the alternative market solve this?
The alternative market created a product specifically for this scenario called a bank statement loan. It bypasses the tax return entirely.
Completely ignores it.
Completely ignores it. Instead of asking for your 1040s or your W-2s, the alternative lender asks you to provide 12 to 24 months of your actual business or personal bank statements.
And what exactly are they analyzing in those statements? They must be looking for something specific.
They are looking for reality. They are looking at the actual verified cash deposits hitting your account every month. They take all the deposits over that 12 or 24-month period and average them out to find your gross monthly cash flow.
Okay.
Then, depending on your specific industry, they apply a standard expense factor.
Okay, wait. What is an expense factor?
It is an assumption of what it costs to run your business.
Give me an example.
If you run a landscaping business, you have high overhead: trucks, fuel, mowers, labor. The lender might apply a 50% expense factor. So if you deposit $20,000 a month, they assume $10,000 goes to expenses, and they use the remaining $10,000 as your qualifying income.
Makes sense.
But if you are that freelance software developer, your overhead is incredibly low. The lender might only apply a 10% expense factor, meaning they use $18,000 a month as your qualifying income.
It's basically the lender saying, look, we recognize that the IRS incentivizes you to look poor on paper,
Yeah.
but we can verify from your raw bank data that you are running a highly profitable operation. So we will lend to you based on the reality of your cash flow.
Precisely. It bridges the massive gap between modern, non-traditional income streams and real estate acquisition.
That's amazing.
But the innovation doesn't stop there. The sources also detail another loan product that takes this concept even further: the DSCR loan.
The debt service coverage ratio loan. Oh man, when I read the breakdown of the DSCR in the sources, I actually had to read the paragraph twice to make sure I wasn't misunderstanding it.
It's a trip.
Because here is where it gets genuinely wild. With a DSCR loan, the borrower doesn't have to qualify based on their personal income at all.
Oh, at all.
Not tax returns, not even bank statements. It is almost like the house itself is treated like an employee that has to apply for its own mortgage based entirely on the rent it can earn.
That is a perfect way to visualize it. The property is the employee. Let's break down the mechanics of the DSCR, because it is the engine driving a massive amount of modern real estate investment.
Let's do it.
DSCR stands for Debt Service Coverage Ratio. It is a mathematical formula that compares the property's income to the property's debt.
Walk me through the math on a hypothetical deal.
Let's say you want to buy a rental property. The alternative lender calculates the proposed debt service, which means the monthly principal, interest, taxes, insurance, and any HOA fees.
Everything combined.
Right. Let's say that total monthly debt obligation is $3,000.
Okay, the hurdle to clear is $3,000 a month.
Right. The lender then orders a specialized appraisal, specifically requesting a rent schedule. The appraiser analyzes the local market and determines that the fair market rental value for this specific home is $3,500 a month.
So the potential rent is higher than the mortgage payment.
Exactly. You take the gross rental income, $3,500, and divide it by the debt service, $3,000.
Okay.
The resulting ratio is 1.17. In the commercial lending world, any ratio greater than 1.0 means the property generates more cash than it consumes.
It sustains itself.
It sustains itself. Therefore, the DSCR loan is approved.
And they genuinely do not care what I do for a living.
They genuinely do not. They do not ask for your W-2. They do not look at your tax returns. They don't even need your bank statements to prove personal income.
That is just wild to me.
You could have zero personal income. As long as you have the required down payment, a qualifying credit score, and the property's math clears that 1.0 DSCR hurdle, the asset's income potential secures the loan.
That is staggering. It completely decouples your personal employment status from your ability to build a real estate portfolio.
It really does.
If I find a property where the math works, I can buy it, regardless of what my day job looks like or what my tax returns say.
And if we connect this to the broader socioeconomic picture, these loan products are quietly democratizing access to asset accumulation.
How so?
For decades, the ability to build wealth through real estate was gatekept by a banking system that only rewarded one specific type of traditional employment.
The 9-to-5 corporate job.
Exactly. DSCR and bank statement loans allow non-traditional earners, immigrants without long W-2 histories, and self-employed innovators to compete in the wealth-building arena.
Okay, I am tracking with all of this. It sounds incredibly empowering. It sounds agile, flexible, and like the ultimate financial cheat code for the ambitious investor.
It's a very powerful tool.
But wait, I'm looking at these numbers from the sources regarding the costs of these loans, and I have to pump the brakes here.
Ah, the catch.
Yeah, because this all sounds a little too perfect. There has to be a catch. What is the actual cost of all this velocity and flexibility? The sources detail the pricing, and honestly, the numbers are shocking.
You are right to be shocked if you are comparing them to consumer mortgages. This is expensive capital.
Very expensive.
This is not a subsidized, government-backed, 30-year consumer product designed to help you buy a family home. This is commercial-grade, high-velocity money, and the pricing reflects the risk and the speed.
Let's lay the numbers out exactly as the sources present them. We are talking about annual interest rates ranging from 9% to 13%.
Right.
And on top of that, lenders charge origination points of 1 to 3% of the loan amount. Let's pause and define points really quickly for the listener. 1 point equals 1% of the total loan amount, correct?
Correct. It is an upfront fee paid to the lender at closing just for originating the loan. So if you are borrowing $500,000 and the lender charges 2 points,
that is a $10,000 cash fee due immediately at the closing table, on top of the 13% ongoing interest rate.
Yes.
Wait, hold on. 13% interest plus a $10,000 fee just to get in the door. That is bordering on predatory credit card rates.
That sounds steep.
If I buy a $500,000 house and pay 13% interest, the monthly payments alone would bleed me dry. It seems like a mathematical recipe for immediate bankruptcy. How on earth is anyone making a profit when the money costs that much?
It is absolutely a recipe for bankruptcy if you treat a hard money loan like a conventional 30-year mortgage.
Okay.
And this is the most critical distinction we can make in this entire deep dive. A 13% interest rate on a 30-year loan would be catastrophic.
You would end up paying for the house 3 times over in interest alone.
Exactly. But you have to remember the time horizon of these tools. These are strictly short-term loans. The typical term is 6 to 12 months.
Okay, so they aren't holding these double-digit loans for 3 decades, but still, the math seems punishing.
To understand why it works, we have to do the math on opportunity cost. Let's walk through a real-world scenario from the perspective of an investor.
All right, walk me through it.
You find a heavily distressed property in Pacific Beach. The seller is desperate and will let it go for $500,000 cash, but they need to close in a week.
Typical San Diego.
You know, based on hard comparable sales data, that if you put $50,000 of renovation work into the property, you can easily sell it in 6 months for $750,000.
Yeah, so the potential upside is massive.
Yeah.
There is $200,000 of gross equity sitting there waiting to be captured.
But here's the problem. You do not have $500,000 in liquid cash sitting in your checking account.
No, I definitely don't.
And the traditional bank won't lend on it because the house doesn't have a working kitchen, making it unlivable by Fannie Mae standards.
Right.
Furthermore, even if the bank would lend on it, they would take 60 days to close, and a cash buyer will steal the deal from you tomorrow.
So my options are stark. Either use expensive hard money or lose the deal entirely to someone else.
Exactly. So you make the calculated decision to take the hard money loan for $500,000 at 12% interest.
Ouch.
Let's do the math. 12% annually on $500,000 is $60,000 a year in interest.
That's so much money.
But remember, you are only holding the loan for 6 months while you renovate and sell, so your actual interest cost is only $30,000.
Okay.
Add in the 2 origination points, that's $10,000. Your total cost of capital to borrow $500,000 for 6 months is roughly $40,000.
I'm following the math.
You bought the property for $500,000. You put $50,000 of your own money into the renovation. You paid the lender $40,000 in interest and fees.
Okay.
Your total all-in cost is $590,000. 6 months later, you sell the renovated property for $750,000. You pay off the original loan, and you walk away with $160,000 in pure realized profit.
Ah, wow. Okay. When you lay the math out like that, it completely changes the narrative.
Now ask yourself, was that 12% interest rate a bad thing? Was it predatory? Or was it simply the necessary cost of doing business?
Right.
Was it just a highly effective tool that allowed you to access $160,000 of profit that you otherwise would have entirely missed out on?
That completely flips the perspective.
Yeah.
It is not a traditional mortgage. It is a toll booth on the highway to profit.
Exactly.
It is significantly cheaper to pay a $40,000 toll and make $160,000 than it is to stubbornly wait for a cheap 6% bank loan, pay a $0 toll, and lose the deal entirely to a faster buyer.
Yeah.
Because 0% of 0 is 0.
That is the fundamental math of opportunity costs. The high interest rate is a precision tool, not a lifestyle.
Right.
However, this math only works if the borrower meets certain qualifications. And the sources are very clear that just because they don't look at tax returns doesn't mean they hand out money to anyone off the street.
Okay, let's talk about those qualifications, because that was another big question I had. If they aren't underwriting my W-2, how do they decide if I actually qualify for the loan? Do I just walk in, point at a house, and ask for $500,000?
Not quite. While the asset is the primary focus, the lender still needs to mitigate their risk regarding the operator. The sources outline 3 main pillars of qualification.
That's the first one.
The first is a minimum credit score. While they won't reject you for a 600 credit score like a prime bank might, they do draw a line. Most hard money lenders want to see a minimum score in the 600 to 650 range.
That makes sense. They need some baseline indicator of responsibility.
Right. A score lower than that suggests a historic pattern of financial unreliability that makes even asset-based lenders nervous. Furthermore, your credit score often dictates your interest rate. A 750 score might get you 9%, while a 620 score might push you to 13%.
Got it. What is the second pillar?
Experience, which directly dictates your loan-to-value, or LTV, ratio. Yes, LTV is the percentage of the property's value that the lender is willing to finance. If you are a first-time investor who has never flipped a house before, the lender views you as higher execution risk.
So they lend you less.
Exactly. They might only offer you a 70% LTV. This means on a $100,000 property, they will only lend you $70,000. You have to bring the remaining $30,000 in cash.
Which gives the lender a huge 30% cushion if I mess up the project.
Precisely. But if you are a seasoned professional who can show the lender a track record of 10 successful, profitable flips in the last 2 years, the lender trusts your ability to execute. They might offer you an 85% or even 90% LTV, requiring much less cash out of your own pocket.
And what is the third qualification pillar?
Liquidity, or liquid cash reserves. Even though the lender is financing the purchase and the renovation, real estate investing is incredibly capital intensive.
Oh yeah, things always break.
The lender needs to see bank statements proving you have enough liquid cash to pay the closing costs, pay the high monthly interest payments during the 6-month holding period.
But you still have to make the monthly payments.
And most importantly, fund that first phase of renovation before the draw schedule reimburses you. If you have 0 cash in the bank, you cannot execute the business plan, and the loan will be denied regardless of how good the property is.
Okay, so it requires a baseline credit score, experience dictates leverage, and you must have actual cash on hand to operate. But even with all those qualifications met, the sources are adamant that there is one overarching requirement that rules them all. They refer to it as the holy grail of alternative lending.
The exit strategy.
The exit strategy. They make it very clear that a vague exit strategy kills the deal instantly.
It is the absolute most critical component of the entire transaction.
Yeah.
A hard money lender will forgive a low credit score. They will forgive a complicated, messy tax return. They will work with a first-time investor. But they will never, ever forgive a borrower who does not have a mathematically sound, highly specific plan to exit the loan.
Because if you don't have a reliable plan to get out of the loan, that 12% interest rate suddenly stops being a tool and transforms back into a ticking time bomb.
Precisely. The exit strategy is how you pay the lender back their principal balance and transition yourself out of that high-interest environment before the short-term loan expires.
So what are the exit strategies?
There are really only two viable exit strategies. The first is selling the asset. For a fix-and-flip investor, the exit strategy is clear. Finish the renovations within 4 months, list the property on the market in month 5, and sell it to a retail buyer using the proceeds to pay off the hard money loan.
And what is the second exit strategy?
Refinancing. This is the path for the multifamily investor we discussed earlier.
Right, the apartment buildings.
Their exit strategy is to stabilize the apartment building, increase the rent roll, and then use that new higher income to qualify for a traditional long-term low-interest commercial bank loan. They use the new bank loan to pay off the expensive hard money lender.
So the hard money loan is essentially the powerful rocket booster that provides the intense thrust needed to get the project into orbit. And the conventional refinance is the stable satellite that keeps it there long term.
That is an excellent way to frame it. If you walk into a hard money lender's office and say, I want to buy this property at 12% interest, and my plan is just to kind of hold on to it, ride the market, and hope values go up.
They will laugh you out of the room.
They will deny the loan and show you the door. Hope is not an exit strategy. The math must prove how you are getting out.
Okay, so we have established that these alternative loans are incredibly powerful tools. But they are expensive, they demand liquid cash to operate, and they require immense discipline and a rock-solid exit plan. But that brings us to the final major theme discussed in the sources. We are dealing with an industry that is, by its very nature, significantly less regulated than conventional consumer banking.
Yes.
That incredible speed and flexibility we've been praising comes at the direct cost of standardized government oversight. The sources spend a considerable amount of time outlining how a borrower must navigate this environment to protect themselves. They call it vetting the lender. Because honestly, it sounds a bit like the Wild West of real estate finance. How do you avoid getting burned?
It is a vital question, and it requires a highly defensive posture from the borrower. Because the exact same lack of regulatory red tape that allows a legitimate private lender to fund your deal in 5 days
is the exact same lack of regulation that allows a predatory lender to bury you in hidden fees.
Or seize your property in a technicality. The sources outline a very specific tactical playbook for surviving and thriving in this lightly regulated space.
The very first thing the sources emphasize in their vetting playbook is the absolute necessity of local market knowledge. And their explanation really resonated with me. They explicitly warn against using large national lenders who are headquartered out of state and rely on generic national underwriting models.
Because real estate is, at its core, a hyper-local asset class, the dynamics of a market can completely change from one zip code to the next. Let's use an analogy.
Okay.
Imagine you are opening a high-end restaurant in San Diego, and you need to hire an executive chef.
Right.
Using a national hard money lender, sitting in a cubicle in a high-rise in New York to fund a complex renovation in San Diego is like hiring a chef who has never stepped foot in your kitchen to cook a 5-course meal.
That's a great analogy.
They might have a generic recipe book, but they don't know that your oven runs 50 degrees too hot, or that the local supplier is completely out of tomatoes this week.
They don't know the local friction points.
Exactly. A national lender in New York is just looking at a spreadsheet. They don't know that the local permitting office in San Diego is currently chronically understaffed and backed up by 4 months.
Right.
They don't know the current availability and pricing of specialized contractors in Southern California. They might blindly approve a renovation timeline of 3 months when anyone actually working in the San Diego market knows that getting the permits alone will take 4.
And then what happens?
When month 3 arrives and the project isn't finished because of local delays, the national lender penalizes you for defaulting on the timeline. A local lender, however, builds those local realities into the original underwriting.
Because they know exactly where the potholes are since they drive on the same roads.
Exactly.
The next crucial defensive step the sources highlight is demanding absolute transparency, specifically regarding the fee structures. As we have discussed at length, hard money is expensive. But the sources argue that the costs while high should be entirely predictable.
Predictability is paramount. There should never be a surprise when you sit down at the closing table to sign the documents.
Never.
A legitimate, ethical hard money lender will provide a clear, binding term sheet up front. This document must explicitly list every single cost. The exact interest rate, the exact number of origination points, the underwriting fees, the appraisal costs, the legal document preparation fees, and any draw inspection fees.
So it's all laid out.
If a lender is vague about their fee schedule, or if they try to slip in a mysterious $3,000 processing fee just 3 days before closing when you are desperate,
That is a massive red flag.
walk away immediately.
The sources also talk about demanding proof of funding. This seemed a bit strange to me at first. Like, if they are a lender, shouldn't it be obvious that they have the funds?
You would think so.
But apparently this is a massive issue in the alternative space. They warn borrowers to ensure they are working with a direct lender rather than someone who is merely brokering the loan. What is the inherent danger of a broker in this specific context?
It goes all the way back to our core currency: speed and reliability. A direct lender is a company that has the millions of dollars of capital sitting right there in their own corporate bank account.
Okay.
When they review your deal and say yes, they have the immediate power to wire the funds to the title company.
Right. They control the money.
A broker, however, poses as a lender to the public, but they do not actually control the capital. They take your application, charge you a fee, and then frantically shop your deal around to a network of actual wealthy individuals or hedge funds trying to find someone willing to fund it.
Which introduces massive, unpredictable delays.
Fatal delays. Imagine the scenario. You submit an offer on a property and put down a $50,000 non-refundable earnest money deposit.
Which is the cash you put up to prove you are serious and which you lose if you fail to close on time.
Exactly. The broker tells you, no problem, we will close in 7 days.
Yeah.
But on day 6, the broker calls you in a panic and says, I'm sorry, the capital partner I thought was going to fund this deal just backed out. I need another 2 weeks to find a new investor.
But the seller won't wait 2 weeks.
The seller cancels the contract, you just lost the property, and worse, you just lost your $50,000 earnest money deposit, all because the entity you thought was lending you the money didn't actually have it.
That is a terrifying scenario.
You must verify up front that the lender is lending their own direct capital.
And finally, the sources hammer home the importance of clear legal documents. We are talking about the fine print, default provisions, extension fees, and prepayment penalties.
This is where the rubber meets the road in a lightly regulated industry. In conventional consumer banking, federal protection laws severely limit what a bank can do to you. In the commercial hard money space, the contract you sign is absolute king.
Give me an example of what to look out for.
Let's look at extension fees. We established that real estate renovations almost always take longer than expected due to unforeseen issues.
Oh yeah, you open a wall and find mold.
Exactly. If you have a 6-month loan, and you need to extend it to 9 months to finish the flip, what does the contract say happens?
I assume a legitimate lender charges a standard administrative fee to extend the timeline.
Yes, a reasonable fee. But a predatory lender might have a clause buried on page 40 that states if you extend past 6 months, your interest rate immediately spikes from 12% to a punitive default rate of 24%.
Wiping out your entire profit margin instantly.
Instantly. Or consider prepayment penalties. If you are incredibly efficient and you finish your flip early, selling the house in 3 months instead of 6, does the lender punish you with a massive fee for paying them back too fast?
Just because they were counting on 6 months of guaranteed interest income.
Exactly.
It's a minefield.
It is, which is why the sources stress, and I cannot emphasize this enough, the absolute necessity of having a qualified real estate attorney review the loan documents before you sign anything, especially if you are a first-time hard money borrower.
Because you are playing in the deep end of the financial pool.
Do not rely on verbal trust or a friendly handshake. Rely solely on the written contract.
Trust, but aggressively verify with legal counsel. So let's pull all of this together and synthesize the journey we have been on today. We started by looking at the traditional conventional banking model, the slow 60-day W-2 obsessed, heavily regulated bottleneck that most of us are familiar with.
Right.
And we discovered that in a hyper-competitive, inventory-starved market like San Diego, that traditional models simply cannot keep pace with the realities on the ground. It creates anxiety for sellers and lost opportunities for buyers.
It fundamentally fails the test of velocity.
Exactly. So we crossed over into the hidden parallel world of alternative financing. We unpacked the hard money paradigm shift, where we learned that by making the asset, the physical property, the star of the show, rather than the borrower's personal tax history, lenders can move at the speed of cash.
Just in 14 days.
We saw how this shift unlocks an incredibly powerful toolkit. Fix and flip loans with disciplined draw schedules, bridge loans to connect misaligned transactions, and ground-up construction capital to build much-needed housing where banks fear to tread.
We also explored the revolutionary changes in underwriting, detailing how these alternative lenders are adapting to the modern gig economy workforce by utilizing DSCR and bank statement loans.
Bypassing the outdated reliance on heavily deducted tax returns.
Right, and evaluating the actual cash flow of the entrepreneur and the asset itself.
But we also face the harsh mathematical reality of the costs. This speed and flexibility come at a steep premium, double-digit interest rates and hefty origination points.
It's expensive money.
We learned that to survive these costs, the borrower must have a rock-solid, mathematically sound exit strategy, whether that is a quick sale or a strategic refinance. Hard money is not a lifeline for desperate borrowers looking for a consumer bailout. It is a highly specialized commercial-grade tool used by the smart money to achieve velocity and capture equity in a cutthroat market.
Absolutely.
And finally, we learned how to navigate the inherent dangers of this lightly regulated Wild West by vetting local lenders, demanding total fee transparency, verifying direct capital, and always having an attorney read the fine print.
It is a complete re-education on how capital can be deployed and valued. And as we wrap up this exploration, I want to leave you, the listener, with a final lingering thought to mull over.
I'd love to hear it.
We have seen how incredibly effectively this asset-based, fast money model works for professional investors, developers, and self-employed entrepreneurs. But if we pull back and consider the broader macroeconomic trends over the next decade, as the gig economy continues to expand and as traditional, stable, 30-year W-2 jobs become less of the norm and more of the exception, what happens to the conventional banking system?
That's a great question.
Will the massive traditional banks eventually be forced by demographic reality to abandon their rigid regulations and adopt these nimble asset-based underwriting models just to survive in a fundamentally changed workforce? Or conversely, are we looking at a permanent, entrenched, two-tiered financial future? A future where the wealthy and the professional investor class use fast money to continually snap up the most valuable assets in a matter of days, while the traditional middle class remains permanently stuck in a 60-day waiting line, constantly losing out on the best opportunity?
That is a deeply provocative and vital question. It really forces you to look at the architecture of the financial world and ask who the system is actually built to serve. Thank you so much for joining us on this deep dive. We hope this extensive exploration has given you a completely new lens through which to view the world of real estate, finance, and the hidden mechanics of how wealth is truly built. Keep questioning the systems around you. Keep looking for the why behind the rules, and we will catch you on the next deep dive.